Hello value investors, thank you for joining me. Today I want to discuss Fiverr and what's interesting about Fiverr, talk about its growth rates, its cash flow profile, and then we're going to bring this all together and talk about its valuation. So my name is Michael from Deep Value Returns on Seeking Alpha, and let's get started. So Fiverr is a freelance marketplace. You have people that are selling their services on the one hand. These can be just individuals or small businesses, and then you have buyers on the other side. And part of the idea here had been that Fiverr was recognized as what's called a work from home trade, and coming out of the COVID period, the share just went high very, very quickly. But many were fearing that as the economy reopened, that there would be less need for this type of business. You could buy that idea or not. That was an idea that was floated around. However, I just put up this one graph here, so it shows that active buyers over the past trailing 12 months has increased to 3.8 million. So there's a lot of buyers going to Fiverr, and it also shows that. I didn't put it here, but it also shows that the spend per buyer is up 22%. So you have 56% year over year over trailing 12 months growth in active buyers, and you also have spend going up by 22%. So those two combined is a very healthy business, very healthy marketplace, because you got on one side many more buyers, the other side many more gig workers. So that's very healthy all around. However, here's how the shares have traded in 2021. You can see it's been just crazy, and investors would have probably just lost their conviction at some point. Even if the underlying business would have been really strong, investors would have just been cashed out. I mean, it's very difficult. It's easy to look in hindsight and say, yeah, I'll take a buy and hold, and there will be one or two individuals obviously that would have survived that, but it's such a difficult thing to do, to be these kind of investors where you're kind of in a stock that's really richly priced and staying there the whole course. It's quite difficult, and most people get called out, obviously. However, if you just to take a step back and if you were to make the argument that I'm willing to withstand the vicissitudes that come along with a high growth stock, if you just take a bit more of a long-term view, you can see, okay, the business is guiding for approximately 63% year-over-year growth rates for 2021. So it has a lot of visibility all the way to the back end of this year. Okay, but you're gonna say, in Q1 2021 it was growing at 100% year-over-year, and going down to Q2 it's only growing at 59%. It's quite a deceleration. Well, for that I would say one thing. Probably management has been a little bit conservative here. On the other hand, you have to think that last year there was an explosive growth rate. So it takes a bit of time for the business to adjust to that, and size does take a toll. So the faster you grow, at some point, nothing grows to the sky. So with those two combined, yes, there is a deceleration, but you're still seeing a business is going to be growing in the mid-60s in 2021. That's still quite attractive. Another thing that I want to talk about is that you can see that as the business is growing, the EBITDA margins improving. This past quarter, it did dip down slightly. It's still up year over year. If you looked at last year, Q1 2020 was negative 8%, and now it was negative 1%. So there is an improvement year over year, but it has taken a slight step back. For that, management's talking about Super Bowl ads costing 8 million this time, was a one-off, and also just investing in the channel brand awareness altogether. So I mean, from my perspective as an investor, this is what you want to see business investing very aggressively in growing its marketing strategy, and you can see it's paying off because growth rates is just going through the roof. Also, it's a marketplace type, so it's just a take rate. So they're taking 27.2% from the services of the gig workers. That's the way that the marketplace works, and you can see that not only does cash flow is higher substantially year over year from basically break even last year to 4.6 million this year, but it has very little capex requirements because it's just taking a fee from the marketplace, from the services in the marketplace. So everything in the cash flow statement is pretty much flowing to free cash flow. So that's really something that as an investor I look towards. Now here's the problem. The stock is priced at approximately 31 times forward sales. It's not crazy, but it's not cheap. So as an investor, you're gonna have to kind of think, yeah, it's very easy to say I'm a buy and hold investor, particularly as the share price is going up. It's really easy to say, oh yeah, I'm a buy and hold. Everyone's a buy and hold as long as the share price is going up. But then when the share price goes down, you start asking difficult questions from your investment, and then you kind of like, maybe it was not such a good idea. So if you're gonna be a buy and hold investor, this could be something that possibly may be attractive to you. But on the other hand, if you think, okay, I'm not that type of investor, I'm someone that kind of prefers to buy something a bit cheaper, then I would obviously say come over to my marketplace, check out my marketplace, deep value returns on Seeking Alpha, do a totally free trial to see if it suits you. I don't think that there's a lot to lose from doing a free trial, and if you like it, stick around, and if you don't, well, see you soon, bye.